Financial analysis and decision-making techniques. Part A. Determine the overall investment requirements of the organisation. Investment is one of the critical decisions for all organisations. Investment decisions can be summarised as identifying investment opportunities and deciding which ones should be accepted. The investment decisions determine the amount of finance needed, and dividend decisions affect the amount of cash available for reinvestment. Organisations will need to prepare cash forecasts to understand what funding will be required in the future. It is much easier to raise funding if time is available, rather than do so in an emergency. The organisation may consider including sensitivity analysis in their forecast to understand the impact of changes in certain variables, such as demand or inflation, on their future cash needs. Any forecast deficiency will need to be funded by borrowing, selling investments, or delaying payments to suppliers and pulling in payments from customers. Sensitivity analysis is essential while taking investment decisions. It is a must to calculate the effect of changes in certain variables, such as demand or inflation, on a forecast period. Part B. Assess the suitability, feasibility and acceptability of alternative sources of short and long-term finance, including initial coin offerings, ICO, available to the organisation to support strategy and operations. A number of sources of finance are available to organisations, although this will vary. For example, a not-for-profit organisation cannot raise equity finance and may not wish to borrow, so will have to finance itself from operating cash flows. As with other key strategic decisions, sources of finance can be evaluated using the SAF model. Suitability is the method to check if finance is appropriate for particular organisational use. For example, a long-term asset can be financed by long-term debt, but it would be inadvisable to finance working capital this way. Acceptability is the way of finding that the method will be acceptable to stakeholders or not, including current providers of finance. For example, risk-averse shareholders might not want a company to take on additional debt. Feasibility aspects focus on the investment probability part. Can the additional finance be raised? Are the banks prepared to lend, or shareholders to invest more money? There are various sources of finance for an organisation. Some of the major sources are retained profits or operating cash flows, issue shares, bank loans, bank overdrafts, loan capital, and initial coin offerings. Part C. Review and justify on decisions to select or abandon competing investments or projects, applying suitable investment appraisal techniques. A number of techniques can be used for investment appraisal. Some key techniques are as below. Return on capital employed, ROCE. This is also known as accounting rate of return or return on investment. It can be used for projects as well as organisations. It is calculated by dividing average annual profit from investment, after depreciation but before interest and tax, from initial investment. It is a simple measure and allows a simple decision rule. Accept all projects with ROCE above the company's target return. However, it ignores the timing of cash flows and the profit figure includes costs which are not relevant costs. Payback period. This measures how many years it takes for cash flows affected by the decision to invest to repay the cost of the original investment. The longer the payback, the higher the risk, so this is a good way of screening out risky investments. However, it ignores the timing of cash flows and also ignores cash flows which happen after the payback period. Net present value. This includes all relevant costs and benefits of a project, and then discounts them to allow for the time value of money. The discount rate used should reflect the company's cost of capital, although may also be adjusted to reflect risk. If the final net present value of all cash flows is positive, then, subject to non-financial factors, the project will be beneficial for the organisation and should go ahead. Internal rate of return. This is the rate of return which, when applied to a set of cash flows, results in a net present value of 0. It is effectively a percentage return and, if it is higher than organisation's cost of capital, the project should be accepted. Part D to F. Assess organisation performance and position using appropriate performance management techniques, key performance indicators, KPIs, and ratios. Analysing organisation performance and position can be done by a wide range of data, including financial ratios, non-financial key performance indicators, and qualitative data such as efficiency ratios, which cover net asset turnover ratio, inventory turnover or days, and receivables collection period. Gearing ratios, which calculate debt or equity, and interest coverage ratios. Liquidity ratios, such as current ratio and quick ratio. Profitability ratios, such as return on capital employed, ROCE, gross profit margin, and operating profit margin, etc.